What's up, guys? Look at GJ. Bunch of liquidity was built right here underneath. Liquidity is gonna take it out right now. NASDAQ tapped into the value area low perfectly. Absolutely perfectly right there. Welcome to the stream. We're gonna talk about the press conference very soon. This is all, baby. This is all pre-game. What's truly important is what's coming. US dollar, euro USD probably going up tremendously. Look at that. Again, go to lower time frame. Where was the liquidity built? Liquidity was built above here. Okay. They're always building liquidity on the lower time frame just before major news releases. Another key prime example right here of the euro USD. If you want to take some risk and you want to trade it, go for the liquidity. Go for where the liquidity is at. Does not always work, but can be very beneficial. Dollar probably massively coming down right now. The euro USD was really going up that dramatically right here. Look at that reaction of the dollar. Very significant decrease right here. Look at that. Bye dollar. Bye dollar. Look at that. That's significant right here. Okay, NASDAQ tapped beautifully in that value area low. Another super important thing I would like to show you guys right now before we're heading into the press conference very soon. This is where tables can turn right now. If you are right now in a position, okay, and you are in profit, take profits very quickly. Like really take some profits right now. Don't try to get greedy. If you are in a massive profit right now, take advantage of that. Take some profits here. Let it run. A percentage if you want to, if you really want to. But overall, get your profits right now. All right. The moment the press conference starts, we could see a flip. We could see a turn around here. Dollar has been coming down all day here. All right. This could be just the beginning of a reversal. I'm not joking. I truly believe that this is possible here. Look at the euro coming down already. Another thing that I would like to show you guys as well. Okay. And this is something that I wanted to test out already many times beforehand. And that is looking at volume profiles. All right. And especially talking about the indices right here. We have the NASDAQ, for example. Look at that beautiful range. We had this whole range right here. Okay. We started to consolidate. But there's pretty much this whole range here on the NASDAQ. We broke through that range. We had that area of consolidation right there. Fixed range volume profile from left to right. Boom. You get your data. Okay. This is the point of control. This is the area where the most volume has been traded. Okay. It's the value area low. What is the value area low? That's the area where the volume suddenly increases. So you went from zero volume to a lot of volume. Okay, this is the first layer of resistance right there. All right, so see this as an area of resistance as well if you're below it. It can be an area of support if you're above it. And then you have the value area high above that. This is where then that fine line is between a lot of resistance and almost no volume right there above. Okay, you have these levels here. You go back and you see that around that zone, and I think I need to adjust this a little bit better. Yeah, I need to adjust it a little bit more here. There we go. We had the zone right there. Because this is where that range started out. There we go. This is where that range started. You have to draw it exactly from the beginning of that range to the end of the range right here. And you tap into that zone. Having a limit order there was amazing. Literally my, and this is no joke, and this is why I'm actually very upset right now with Black Bull Markets myself. I was placing limit orders here for the NASDAQ. Not on the value area low. Okay, gotta be honest here. At the point of control. I put it at the point of control, which is right above. Did not execute. This was 15-20 minutes before the news here. Okay. I tried it on the eurjpy. 15-20 minutes before the news. Did not execute my trades. I could not even open my limit order. So that's actually really pisses me off a little bit in regards to a brokerage, a firm or whatever that does not work at crucial moments in the market here. I have not experienced that before. That's also the reason why I didn't want to do a review yet, or I want to promote this broker yet as well. I wanted to test it out in full. That's why I already said before, I'm not an affiliate. I'm just testing it out after a Wanda. But again, so this is something that can occur right here. So for that particular reason, couldn't put in a limit order. If you guys have also the same problem, let me know in the chat. If you guys use Black Bull Markets and it didn't work for you, for me, it did not work. Just to clarify this, unfortunately though, I have some other positions open as well on my other account, on MetaTrader. But yeah, unfortunately, I cannot do this on the on TradingView right now, and I miss a massive balance of my account right now with this. I wanted to trade at least 0.5% on this account here. It's $400,000. Could have been a nice profit for you guys to see, and to actually follow what we were doing here. In regards to the NASDAQ, we would not get filled, but for the eurjpy, we definitely would. So that's a big of a deal here. Anyways, welcome to the stream. What we're gonna do, we're gonna wait. We're gonna observe the market right now. We are not done yet. We're gonna see what's going on happen with the press conference. We're gonna watch the press conference live here. I'm excited. Hope you guys are too. If you like what we're doing here, please smash that like button. I was gone out of nowhere. The electricity went off. Okay, so I had to run. I had to call somebody. Had to run outside, and we went to the meter, like the whatever electricity hub, and we fixed it. And we got back on track here. So fortunately, we're back again for the FOMC meeting. Our second stream of today. I hope you guys like it. If you guys like it, then please smash that like button. Let's crush it together, because it's going to be a fun one. We're going to listen to Uncle Jerome. And we're going to see what is happening right there. But look at that. Look at that, what's happening with the eurjpy. Look at what's happening with the dollar, okay? These massive reactions are very, very normal. This is completely normal, all right? Coming down, immediately reversing back up, back to the entry, back to where it came down from in a matter of minutes, all right? This is part of the game. So, again, this is typical, behavior or FOMC behavior. We had that report coming out here. Let's go over it right now. Quickly want to show you guys as well what is happening on that front right now. But I believe, there we go, we're almost there. Let me remove all the noise here real quick. Boom. Yes, 25 basis points. Okay, 25 basis point rate hike again. So far, it's doing exactly what we wanted it to see for the NASDAQ. I wanted to put a sell limit, could not get into my limit order right here. So I was aiming for the NASDAQ to come back down right now, to take out that liquidity. We have been talking about this also during the news, pretty much. During the news, during the last stream a couple hours ago. We're talking about this particular area of liquidity below that zone here, coming back into that area of consolidation and potentially getting that rejection there. A little bit higher could also be there, and then coming down. Okay, this is so far playing out. This is kind of interesting to see right now with the NASDAQ, and this is super important for us to also evaluate for not just today, but also for the next coming days, maybe even weeks ahead of us here in regards to, the stock market and everything that's happening right there on that front right now. The most important thing to take consideration to look at is, of course, the dollar. It's all about the dollar and about how all these other pairs and currencies are reacting to that. So based on the dollar, we will have more information. As you guys know, the euro came up significantly right here, was building a beautiful amount of liquidity to the upside. The way it works is always get your profits, get out of it. If you trade the FOMC meeting, you then wait and see what happens in the press conference when the tables potentially turn around here. All right. Very, very nice. Welcome, welcome. Trader of X, my man. Hope you're doing well again. GT Water, yeah, man, as well. We have GG. Fantastic. Beautiful, beautiful, beautiful. I got the pump on EU. Amazing. Fantastic. And that's very great to hear. I got it too on another account here. Minor position, but yeah, we got at least a trade there. Right there. Unfortunately, didn't work on TradingView. Abhishek, my man. Hope you're doing well, my friend. Why bearish for the dollar? Yes. Well, you will see. You will see. We can turn easily here. Cowboy. Let's go. Pedro. Ghost FX, I'm curious how you approach the news. Well, exactly like we thought already beforehand with the NASDAQ. I was coming up to then potentially come down. And then in regards to the euro, we're simply just looking for the liquidity. Where's the liquidity built right here? And what is the next step right now? During the press conference, volatility will increase again. Okay, which is in like 15 minutes from now. We're going to watch this live. I'm excited for it. And I think it's going to be super important to take in consideration right now, listening to our man, the myth, Uncle Jerome. All right? Gonna be fun. Kizzy, my man, hope you're doing well. Are we still having any market orders? Potentially. Jakub. DJ Sprays, what's good? Looks like your new set play studio finally moved to your new house. Yes, sir. Yes, sir. It's completely empty. But we're here. We're here. It's gonna be good. There we go. Any questions you guys have right now, let me know in the chat before we move back to the charts here. And so we can, yeah, we can start. We can start and we can wait for Jerome Powell helping us out here. Giving us the volatility we need right now. Kristen says still in Bali. Yes, still in Bali. How are you looking to enter gold? I need to see what gold is doing right now. I was focusing on the NASDAQ and the eurojpy mainly. And the reason why, because I just saw there, I saw the most potential right there for the eurojpy and the NASDAQ already beforehand. For gold, we were talking about gold indeed. Let's go to the gold right now. Let's go over the charts real quick. Analyze it for there. Yeah, okay, so nothing spectacular here, to be honest. We went up, we came back down, we're back at entry. It's literally back at where we left right now, okay? So yeah, that's typical FOMC behavior. Everyone likes to trade the FOMC meeting, then forget about the actual press conference that is there, where the actual, magic tends to happen here, and sometimes even after that. So yeah, this is going to be very, very interesting right now. It's 2 a.m. 2 a.m. here in Bali. 2 a.m. at the moment. 2:15. I'm here for you guys still. Can't wait to listen to what our uncle has to say. Because it's super important. Not only for the stock market, not only for, all the Americans, for all the other currencies that are related to it, but also for the cryptocurrency market as well. So even for Bitcoin, this is extremely important tonight. You just spray straight fire, bro. The couch reminds me to a picture with a single woman and a couple guys behind the couch. All right. Screen is blurry. Is that the case? Yes? Is it blurry? I think it's all fine. I think it's all good. I think it should be good right now. Okay. Let's listen to some news right now. Okay, we have to wait. There is nothing right now. There is no trade now at this particular moment. Okay. At least not now. We have to wait for the press conference, which will start in around 15 minutes. The NASDAQ was one of my favorites right here. Still is one of my favorites as charts to look at. So my focus will probably be around the NASDAQ, maybe gold, and probably also the Euro-US dollar. So these three charts is what I'm looking for. Okay? Commodity, indice, and a Forex pair. I think this is something that we could look for. There we go. We're going to start very, very soon with our man, the myth, Uncle Jerome. Excited or excited? Lorenzo, we're showing a new building very, very soon, man. Very, very soon. It's going to be amazing. It's going to be nice. Okay, gold is back, ranging right now. It's waiting for what we have to wait for right now. There is literally no volume. We had that expansion. We had that massive expansion to the upside here. Same for the Nasdaq. Nasdaq came down straight away. Euro came down straight away. It's literally pretty much what we expected right now. Have a massive expansion and then literally no volume until the actual news here. I'm excited. Again, guys, what's super important here to take consideration is that you literally wait for or listen to the sentiment. We're always talking about not what he's exactly saying, but the tonality of what he's actually saying. What he's actually, what's this, like underlaying layers. These layers that are actually telling the real, it gives him the impression that like maybe he wants to, give us the impression at least that the market itself is looking fantastic and stuff. And he goes more into a defensive mode where he's trying to make things feel safe and secure. Or maybe he's going to be extremely fierce. We have to fight inflation. We really have to get it down. It was not enough. Like, what is his tonality? Is he aggressive? Is he very passive? Based on that, we can kind of, understand if the dollar would go up or down, or if it's, a very, very hawkish, for example, outcome. This is what we're waiting for right now. And I think with Uncle Jerome, like the way they formulate these scripts, and this is also something that I would like to talk with you guys about, is that usually what he does is he starts out very positive, right? He starts out very positive, he starts out very aggressive, like very, okay, we need to do this, we need to do that. And then during the end, he kind of transitions back to, oh yeah, no, but the unemployment rate is still extremely low. And, the workforce, the labor force is extremely strong. So everything is good on that end. It's kind of like, you want to see the transition. All right, we call this the Jordan Belfort straight line persuasion. All right, a straight line system where he wants to keep us within a certain range. We cannot, overextend too much, but we cannot also get too, pessimistic about it. So he's trying to get us up there, keeping us within that line, within that circle, and then like leaving us or leading us towards the end of the stream, or at least after the Q&A, towards a kind of a positive outcome. So we kind of feel good about it. All right. So it's going to be very, very interesting. And I think that the NASDAQ is still one of my favorites. I'm not sure if I will take another trade here. Who knows? We will find out. We will find out. We're going to find out very, very soon. If the right setup occurs, we will. I'm not just going to take a trade just because I feel like I have to. Again, the first chance we had was during the FOMC meeting. The eurojpy was one of them. The NASDAQ was one of them. So right now it's time to wait, be patient, understand market structure, focus on the market structure itself, the opportunities that are presenting themselves, and then at the same time have a look at potentially, any particular setups that are really aligning with the dollar. Okay. Ghost and Fixes, this is the first time I want to watch a press conference. This will be new. You're gonna find out, my man. You're gonna find out. To be honest, my bias, if we're talking about my personal expectation, to be honest, I would say that the main focus is gonna be a bullish dollar. I could be completely wrong. But I think there is a possibility that we're going to see a bullish dollar eventually. And that therefore gold potentially comes down, euro US dollar will come down. Especially after that initial, massive expansion right now to the upside, now coming back down. Dollar also, coming down, potentially coming down and then coming up. I do believe it's still possible here. Again, guys, the most important level to take consideration is always and will be always the Sunday open. Where did we open the market? When the dollar, opened pretty much on a Sunday, or a Monday for most of us as well. If that's here right there, you can see that 101.671 is the level to look out for. The most crucial level to look out for right now at the moment. Why is that? Well, look at this. Is that a complete range? And you see already that this is acting as resistance. Support, resistance, support, and again, even on the lower time frame, it was acting as resistance the moment it broke below it. Okay, we came below, came up, got rejected, and we came back down right there. Again, why is that? Well, that's exactly what we're saying. All right, it's Sunday open right there, exactly on that level. If you go back to the 1 hour chart, you get what I mean. There is kind of like a line right here. It's a tool or an indicator. You can use it. It's called Sunday Open. Very straightforward. It shows you just every single moment the market opens up. And this is important because every time it can act as a very crucial layer during that specific week. It can act as support, it can act as resistance. In this case, it acted as perfect resistance right there. Okay, so that's why we use it to look out for the major zones right there within that particular range of that particular week. You see clearly that we got rejected very significantly after we felt and broke below it twice, then come down. Okay, and this is on the hourly chart. Therefore, it's super important to measure this and to make sure that, let's say we are coming up here, then what is going to happen around that particular level? Okay. That's what we're trying to figure out. Because if we break and we close above it, it can act as a very bullish, indicator as well. So that could definitely increase our chances for, whatever, shorting the euro US dollar, gold maybe potentially, and based on that we will have much more data, much more pretty much confluence to work with as well. I do use Fibonacci's. Yes, I use them a lot here. A little bit different than usual, but yeah. I also use the 50%, which is actually not a Fibonacci sequence. So that's the dollar, guys. I'm excited. I can't wait. In 5 minutes, we should see this getting started right now. This should be the most updated version. Let's see what we have here.
It was, it's gone off in the crisis.
It was driven by, let's be clear, that was driven by the chairman himself.
Yes, I agree. I totally agree. They're going to get back to a more focused process. That would be one guess.
Well, let's focus on the next 4 minutes. In about 4 minutes' time, we will have a news conference with Chairman Powell. Rich, let's wrap it up there. What would be your focus going into this news conference, just as a spectator now from outside the Federal Reserve, looking at this play out?
Well, thank you for that question. I do think that the statement today will be helpful in that.
Okay, perfect.
Because I do
Thank you.
think the goal coming into the meeting, notwithstanding what we saw with First Republic, was to give themselves the option to pause. But certainly, I think the chair will stress that they're not. It's not mission accomplished, and they've got a lot of work to do. So I think
just to clarify, guys, real quick, just clarify. This is super important for you if you have no experience with. Press conferences like this, understand that price can literally go in either direction. Every single question that he answers, if there is one question that is quite unusual, price can suddenly turn around. Okay? So it can be either super boring or it can be super exciting. So be aware of that and make sure that you are, open-minded, you actually learn or listen to what he says here, trying to find these golden nuggets. Because you will hear a lot in regards to the dollar and how everything operates in general and why these interest rates are crucial right now for the overall economy right now.
Can they give us? Oh, and if it's not that, how much are you looking at specific components within the inflationary reads? These are some of the issues, as well as, of course, the big elephant in the room.
TK, it's going to be an interesting 60 minutes, isn't it?
I think it is. I've said all along this press conference is going to be interesting in how he frames it out to the coming meetings here. What's so interesting is Professor Clarida alluded to is the wide set of issues here that are really outside the capabilities of this institution. And yet he's got to allude to them. Will he comment on them?
Well, there's another one, isn't it?
To see.
We haven't talked about it in the last 60 minutes, the debt ceiling. Nobody wants to talk about it because what can you say? But ultimately, you'd have to think you get to the June decision, Elisa, and you could be at a very interesting point down in Washington, D.C.
How much is the debt ceiling debate tightening financial conditions in the very short end and making the
This is
job
interesting
more
already.
difficult around regional banking because you're seeing those 3-month T-bill yields at the highest levels now, going back to 2001. Is this because of monetary policy? I don't think so. I think this is a debt ceiling disruption kind of issue.
Also, if you get the kind of spending cuts that the Republicans would like to see, Tom, you've got to factor that into your projections at some point as well.
That's clearly outside the scope of this press conference. But what I would go back to is their estimate of the real economy. And do we get any whisper?
By the way, one more thing. We didn't do any giveaways today in this last stream here. Okay. Why? Of course, electricity went off here. So if we reach the 300 likes, our first giveaway will be here. Okay. We have 362 people watching. We have 88 likes right now. If we have 300 likes, we're going to do our first giveaway straight away as well. While we are listening to whatever it is, we're going to figure it out. So smash that like button here. As you always know, we're giving away, cash every single stream. $50, $100. Why not? Giving back to the fam here, right? 300 likes.
Those of you on Bloomberg Radio, it's a different view, a different set of wonderful flags at the Fed, the podium, the people lined up. It's a whole new set, a whole new look. I think taking after Lagarde, the set matters.
The site, Tom, it looks precisely like the last set that he stood at. Has it really changed?
I wasn't here for the last Fed meeting.
It doesn't look like it's changed.
They must have changed it last time around.
You're more detail focused, Tom. Maybe it has changed, but I can't notice the difference. We're waiting for Chairman Powell to walk into that room. A 25 basis point interest rate hike. Going into it, your equity market is positive by 0.4% on the S&P 500. The bond market yields are just a little bit lower by 3 basis points on a 2-year, 393. Yes, TK?
He's late. I mean, what's it mean? What's its signal?
What's his signal? What's his signal? He's going through the senior loan officer opinion survey.
Just to make sure everything's okay. This is actually unusual. Usually he's pretty prompt. Have you noticed that? This is actually...
He could be on the phone with Goldsby.
I'm not going to read too much into Chairman Powell being seconds late. He's walking into the room right now. The chairman of the Federal Reserve, after hiking interest rates by 25 basis points. Let's listen in.
Good afternoon. Before discussing today's meeting, let me comment briefly on recent developments in the banking sector. Conditions in that sector have broadly improved since early March, and the U.S. banking system is sound and resilient. We will continue to monitor conditions in the sector. We're committed to learning the right lessons from this episode, and will work to prevent events like these from happening again. As a first step in that process, last week we released Vice Chair for Supervision Barr's review of the Federal Reserve's supervision and regulation of Silicon Valley Bank. The review's findings underscore the need to address our rules and supervisory practices to make for a stronger and more resilient banking system, and I'm confident that we will do so. From the perspective of monetary policy, our focus remains squarely on our dual mandate to promote maximum employment and stable prices for the American people. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by a 1/4 percentage point. Since early last year, we've raised interest rates by a total of 5 percentage points in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. We are also continuing to reduce our securities holdings. Looking ahead, we'll take a data-dependent approach in determining the extent to which additional policy firming may be appropriate. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. The pace of economic growth in the first quarter of this year continued to be modest at 1.1%, despite a pickup in consumer spending. Activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment.
There we go. Again, sorry guys. 2%, getting inflation down to 2%, strong labor market, and so on and so on.
345,000 jobs per month. The unemployment rate remained very low in March at 3.5%. Even so, there are some signs that supply and demand in the labor market are coming back into better balance. The labor force participation rate has moved up in recent months, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. But overall, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in March, total PCE prices
Look at the Sunday Open.
4.2%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets.
Euro coming down hard.
The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective.
Of course.
At today's meeting, the committee raised the target range for the federal funds rate by a 1/4 percentage point, bringing the target range to 5 to 5.25%. And we're continuing the process of significantly reducing our securities holdings. With today's action, we have raised interest rates by 5 percentage points in a little more than a year. We are seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, particularly housing and investment. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In addition, the economy is likely to face further headwinds from tighter credit conditions. Credit conditions had already been tightening over the past year or so in response to our policy actions and a softer economic outlook. But the strains that emerged in the banking sector in early March appear to be resulting in even tighter credit conditions for households and businesses. In turn, these tighter credit conditions are likely to weigh on economic activity, hiring, and inflation. The extent of these effects remains uncertain. In light of these uncertain headwinds, along with monetary policy restraint we've put in place, our future policy actions will depend on how events unfold. In determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We will make that determination meeting by meeting based on the totality of incoming data and their implications for the outlook for economic activity and inflation. And we are prepared to do more if greater monetary policy restraint is warranted. We remain committed to bringing inflation back down to our 2% goal and to keep our longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thanks, Gina.
Hi, Gina Smilik, New York Times. Thanks for taking our questions. I wonder if you could tell us whether we should read the statement today as a suggestion that the committee is prepared to pause interest rate increases in June. And I also wonder if the Fed staff has in any way revised their forecast for a mild recession from the March minutes. And if so, what a recession like what they're envisioning would look and feel like when it comes to, for example, the unemployment rate.
So, taking your question, of course, today our decision was to raise the federal funds rate by 25 basis points. A decision on a pause was not made today. You will have noticed that in the statement from March, we had a sentence that said the committee anticipates that some additional policy firming may be appropriate. That sentence is not in the statement anymore. We took that out, and instead we're saying that in determining the extent to which additional policy firming may be appropriate to return inflation to 2% over time, the committee will take into account certain factors. So that's a meaningful change that we're no longer saying that we anticipate. And so we'll be driven by incoming data, meeting by meeting, and we'll approach that question at the June meeting. So the staff's forecast is so. Let me start by saying that that's not my own most likely case, which is really that the economy will continue to grow at a modest rate this year. And I think that's, so different people in the committee have different forecasts. That's my own assessment of the most likely path.
Okay, well, important.
Staff produces its own forecast, and it's independent of the forecasts of the participants, which include the governors and the Reserve Bank presidents, of course. And we think this is
probably push the dollar down again.
The staff is writing down what they really think. They're not especially influenced by what the governors think, and vice versa. The governors are not taking what the staff says and just writing that down. So it's actually good that the staff and individual participants can have different perspectives. So broadly, the forecast was for a mild recession, and by that I would characterize as one in which the rise in unemployment is smaller than has been typical in modern era recessions. I wouldn't want to characterize the staff's forecast for this meeting. We'll leave that to the minutes, but broadly similar to that.
Rachel.
Thank you, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. I'm wondering if you can talk about the account of possible effects of a debt limit standoff. You've said repeatedly
There we go.
the ceiling must be
Boom.
raised.
Amazing question.
Do you see any economic
What about the debt
getting
limit?
close to a default, and what type of situation would that look like?
So I wouldn't want to speculate specifically, but I will say this. These are fiscal policy matters, for starters, and they're for Congress and the administration, for the elected parts of the government to deal with, and they're really consigned to them. From our standpoint, I would just say this. It's essential that the debt ceiling be raised in a timely way so that the U.S. government can pay all of its bills when they're due. A failure to do that would be unprecedented. We'd be in uncharted territory, and the consequences to the U.S. economy would be highly uncertain and could be quite averse. So I'll just leave it there. We don't give advice to either side. We just would point out that it's very important that this be done. And the other point I'll make about that, though, is that no one should assume that the Fed can protect the economy from the potential, short and long-term effects of a failure to pay our bills on time. It would be so uncertain that it's just as important that we never get to a place where we're actually talking about or even having a situation where the U.S. government's not paying its bills.
And just to follow up, was discussion around the uncertainty of a possible standoff, did that affect today's monetary policy decision at all?
I wouldn't say that it did. It was, of course, it's something that came up. We talk a lot about risks to the outlook, and that come up. A number of people did raise that as a risk to the outlook. I wouldn't say that it was important in today's monetary policy decision yet.
Steve.
Chairman, oh, thank you. Yeah, Steve Leisman, CNBC. Can you tell us what the Federal Reserve Board did in the wake of that February presentation where you were informed that Silicon Valley Bank and other banks were experiencing interest rate risks? And can you tell me what supervisory actions you've done in the wake of the recent bank failures to make sure that banks are currently appropriately managing interest rate risk? And kind of part three, but it's all the same question here. Do you still think this separation principle, that monetary policy and supervision can be handled with different tools? Thank you.
Sure. So the February 14th presentation, I didn't remember it very well, but now, of course, I've gone back and looked at it very carefully. I did remember it. And what it was a general presentation. It was an informational briefing of the whole board, the entire board. I think all members were there. And it was about interest rate risk in the banks. And
pretty stable so far.
Lots of data. And there was one page on Silicon Valley Bank, which talked about the amount of losses mark-to-market losses they had in their portfolio. There was nothing in it about, that I recall anyway, about the risk of a bank run. So it was, I think the takeaway was they were going away to do an assessment, a horizontal assessment of banks. It wasn't it wasn't presented as an urgent or alarming situation. It was presented as an informational, non-decisional kind of a thing, and I thought it was a good presentation, and as I said, did remember it. In terms of what we're doing, of course, I think banks themselves are many banks are now are attending to liquidity and taking opportunity now, really since the events of early March, to build liquidity. You asked about the separation principle. Like so many things, it's very useful, but ultimately it has its limits. I mean, I think.
So the questions are written down, all right? So keep that in mind, all right? These questions are all prepared.
Like they're working well together. We've used our financial stability tools to support banks through our lending facilities, and at the same time, we've been able to use our monetary policy tools to foster maximum employment and price stability.
Mr. Chairman, I'm sorry. I don't mean to be argumentative, but the staff report said SVB has significant interest rate risk. It said interest rate risk measurements failed at SVB, and it said banks with large unrealized losses face significant safety and soundness risk. Why was that not alarming?
Well, I mean, I didn't say it wasn't alarming. It was, they're pointing out something that they're working on and that they're on the case. That I'm not sure whether they mentioned. I think they did actually. They mentioned that they had taken regulatory action, or supervisory action in the form of matters requiring attention. So I think that was also in the presentation. I think it was to say, yes, this is a bank, and there are many other banks that are experiencing these things, and we're on the case.
Go to Victoria. Hi, Chair Powell. I wanted to ask, obviously, with the recent bank turmoil, we've seen multiple banks buy other banks, and I was just curious whether you think that further consolidation in the banking sector would increase or decrease financial stability, and whether you have any concerns about the biggest bank in the U.S. Getting even larger.
So, we certainly don't, and I don't have an agenda to further consolidate banks. Consolidation has been a factor in the U.S. banking industry.
Good question about these banks. To be honest, all the small banks need to go first. The big banks gain more control, and then it's waiting for the inevitable right there.
I personally have long felt that having small, medium, and large-sized banks is a great part of our banking system. The community banks serve particular customers very well. Regional banks serve very important purposes, and the various kinds of GSIBs do as well. So I think it's healthy to have a range of different kinds of banks doing different things. I think that's a positive thing. Is it a financial? So I would just say, in terms of J.P. Morgan buying First Republic, the FDIC really runs the process of closing and selling a closed bank completely. That is their role, so I really don't have a comment on that process. As you know, there's an exception to the deposit cap for a failing bank. So it was legitimate, and I think the FDIC, I believe, is bound by law to take the bid that is the least cost bid. So I would assume that's what they did.
So, but do you have any concerns about the fact that they're getting larger in general?
So I think it's probably good policy that we don't want the largest banks doing big acquisitions. That is the policy, and but this is an exception for a failing bank, and I think it's actually a good outcome for the banking system. It also would have been a good outcome for the banking system had one of the regional banks bought this company, and that could have been the outcome. But ultimately, we have to follow the law in our agencies, and the law is it goes to the least cost bid.
Let's go to Colby.
Thank you. Colby Smith with the Financial Times. At the March meeting, you mentioned that a tightening of credit conditions from the recent bank stress could be equal to one or more rate increases. So given developments since then, how has your estimate changed?
Yeah, I think I followed that up by saying it's quite impossible to have a precise estimate of the words to that effect. But in principle, that's the idea. When we've been raising interest rates, and that raises the price of credit, and that, in a sense, restricts credit in the economy, working through the price mechanism. And when banks raise their credit standards, that can also make credit tighter in a kind of broadly similar way. It isn't possible to make a kind of clean translation between one and the other, although firms are trying that, and we're trying it. But ultimately, we have to be honest and humble about our ability to make a precise assessment. So it does complicate the task of achieving, a sufficiently restrictive stance. But I think conceptually, though, we think that
dollar coming back down.
Rates, in principle, we won't have to raise rates quite as high as we would have had this not happened. The extent of that is so hard to predict because we don't know how persistent these effects will be. We don't know how large they'll be and how long they'll take to be transmitted. But that's what we'll be watching carefully to find out.
Just to quickly follow up, what does it suggest about the scope for the committee to pause rate increases perhaps as early as next month, even if the data remains strong then, if it's having some kind of substitute effect?
This is just something that we have to factor in as we want to find ourselves. So I guess I would say it this way. The assessment of the extent to which additional policy firming may be appropriate is going to be an ongoing one, meeting by meeting, and we're going to be looking at the factors that I mentioned that are listed in the statement, the obvious factors. That's the way we're going to be thinking about it. That's really all we can do. As I say, it does complicate. We have, a broad understanding of monetary policy. Credit tightening is a different thing. There's a lot of literature on that, but translating it into, into rate hikes is uncertain. Let's say it adds even further uncertainty. Nonetheless, we'll be able to see what's happening with credit conditions, what's happening with lending. There's a lot of data on that, and we'll factor that into our decision making.
Howard Schneider with Reuters. Thank you. So noting that the statement dropped the reference to sufficiently restrictive, I was wondering, given your baseline outlook, whether you feel this current rate of 5 to 5.25% is in fact sufficiently restrictive.
So that's going to be an ongoing assessment. We're going to need data to accumulate on that. Not an assessment that we've made. That would mean we think we've reached that point, and I just think it's
so far. I think
it's not possible to say that with confidence now.
So far, same bias. I think dollar eventually coming up, gold coming down, NASDAQ coming down, potentially eurojpy coming down. So far, I'm still in the same. I have the same bias. If anything changes, we will find out very, very soon.
Of the ultimate high level of rates, we don't know that. We'll revisit that at the June meeting. And that's, we're just going to have to, before we really declare that, I think we're going to have to see data accumulating and make that, as I mentioned, it's an ongoing assessment.
And a follow-up on credit, but could you give us a sense of what the SLUS survey indicated? It was already, I think 45% of banks were tightening credit as of the last survey. What did this one show, and how did that weigh into your deliberations?
So we're going to release the results of the SLUS on May 8th, in line with our usual time frame. And I would just say that the SLUS is broadly consistent when you see it with how we and others have been thinking about the situation and what we're seeing from other sources. You will have seen the Beige Book and listened to the various earnings calls that indicate that mid-sized banks some of them have been tightening their lending standards. Banking data will show that lending has continued to grow, but the pace has been slowing really since.
Look at the 1 hour candle closure here on the dollar. Coming closer and closer, 7 minutes.
Nick Tamaros of the Wall Street Journal. Chair Powell, the argument around the end of last year and the beginning of this year to slow down the pace of increases was to give yourself time to study the effects of those moves. After the bank failures in March, as you've discussed, the Fed staff projected a recession starting later this year. So my question is why it was necessary to raise interest rates today, or put differently, if the whole point of slowing down the pace was to see the effects of your moves, and now you've, for the last 2 meetings, been seeing the effects of those moves. Why did the committee feel it was necessary to keep moving?
Well, the reason is that we, again, with our monetary policy, we're trying to reach and then stay at for an extended period, a level of policy stance that's sufficiently restrictive to bring inflation down to 2% over time. And that's what we're trying to do with our tool. I think slowing down was the right move. I think it's enabled us to see more data, and it will continue to do so.
Pretty neutral for where we are.
We always have to balance the risk of not doing enough and not getting inflation under control against the risk of maybe slowing down economic activity too much. And we thought that this rate hike, along with the meaningful change in our policy statement, was the right way to balance that.
And just to follow up, you said in response to Howard's question, you'll need data to accumulate to determine if this is a sufficiently restrictive stance. Does that data need to accumulate, or could it accumulate over a longer period than a 6-week intermeeting cycle?
As I mentioned, I would just say that this assessment will be an ongoing one. You can't, with economic data, you can't. You've seen, take inflation from it. Look back. We've seen inflation come down, move back up 2 or 3 times since March of 2021. We've seen inflation have a few months of coming down and then come right back up. So I think you're going to want to see that, that a few months of data will persuade you that you've got this right.
There we go. Look at that, guys. Look at the point of control.
We've raised 500 basis points. I think that policy is tight. I think real rates are probably, that you can calculate them many different ways, but One way is to look at the nominal rate and then subtract a reasonable.
This is where my limit order was placed.
Let's say 1 year inflation, which might be 3%. So you've got 2% real rates. That's meaningfully above what most people would, many people anyway, would assess as the neutral rate. So policy is tight, and you see that in interest-sensitive activities, and you also begin to see it more and more in other activities. And if you put the credit tightening on top of that and the QT that's ongoing, I think you feel like we may not be far off, or possibly even at that level.
Okay, good question. Let's go.
Powell. Edward Lawrence with Fox Business. So if the Federal Reserve gets down to the 3% inflation as the projections show at the end of this year, or close to it, would it be okay for you for a prolonged period of 3% inflation and hoping for some outside event to move down to 2% target?
Look, I think we're always going to have 2% as our target. We're always going to be focusing on getting there.
Would you be okay with a prolonged 3%?
It's let me just say that's not what we're looking for. We're looking for inflation going down to 2% over time. I mean, that's not a question that's in front of us, and it would depend on so many other things. But ultimately, we're not looking to get to 3% and then drop our tools. We have a goal of getting to 2%. We think it's going to take some time. We don't think it'll be a smooth process, and I think we're going to need to stay at this for a while.
How does the other side of the mandate, the job side, once you get to 3%, going from 3 to 2, how does the other side of the mandate balance?
I think they will both matter equally at that point. Right now, you have a labor market that's still extraordinarily tight. You've still got 1.6 job openings, even with the lower job openings number, for every unemployed person. We do see some evidence of softening in labor market conditions, but overall, you're near a 50-year low in unemployment. Wages, you all will have seen the wage number from late last week, and it's whenever it was, and it's
okay. Real quick, guys. So the dollar right now will close in around 2 minutes from now. It's a super important moment for the dollar right now. You see already, it's literally showing, or does not show us a significant outcome yet of a direction. We're still kind of in the middle of a wick. We came down, we came back up, and we're ranging in between right now. Of that range. We're literally back at the exact level where we dropped initially from during the FOMC meeting itself. This counts for the euro, this counts for gold, all the levels right now at the moment. At the same time, you see that the NASDAQ came exactly to that zone which we were talking about here, the point of control of this whole range. And again, use this in your advantage, also with Bitcoin, also with the indices here. It's so powerful. Consolidation, expansion, retracement, continuation, all that liquidity was there below. We're not there yet. However, look how it taps into that zone. And it gets rejected from there. So, yeah, another hour to go. In 1 minute, we close our 1 hour candle. And we continue from there to see what the dollar can do. So far, nothing spectacular yet.
Participants think, because you don't know what they were thinking for first quarter GDP at that point. They could have been thinking about a fairly low number. Anyway, in any case, I'll just say I continue to think that it's possible that this time is really different. And the reason is there's just so much excess demand really in the labor market. It's interesting, as we've raised rates by 5 percentage points in 14 months, and the unemployment rate is 3.5%.
There we go.
Pretty much where it was, even lower than where it was when we started. So job openings are still very, very high.
Strong labor force, very low unemployment rate.
I think conditions are cooling, but it really is different. It wasn't supposed to be possible for job openings to decline by as much as they've declined.
That's what pushed the dollar down.
Well, that's what we've seen. So there are no promises in this, but it just seems that to me that it's possible that we can continue to have a cooling in the labor market without having the big increases in unemployment that have gone with many, prior episodes. Now that would be against history. I fully appreciate that. That would be against the pattern. But I do think that the situation in the labor market with so much excess demand, yet wages have been moving down. Wage increases have been moving down, and that's a good sign. down to more sustainable levels. So I think it's still possible. I think the case of avoiding a recession is, in my view, more likely than that of having a recession. But it's not that the case of having a recession is. I don't rule that out either. It's possible that we will have what I hope would be a mild recession.
The committee also noted in March that wage growth was still well above levels that would be consistent with 2% inflation. Do you see that as well? And could you kind of explain, how you come to that judgment?
Sure. So we look at a range of wage measures, and then that's a nominal. And then so you assume wages should be equal to productivity increases plus inflation. And so you can look at the Employment Compensation Index, average hourly earnings, the Atlanta Wage Tracker, compensation per hour, basically those four, and many others, and you can look at what they would have to run at over a long period of time for that to be consistent with 2% inflation. They can deviate. Corporate margins can go up and down, and there is a feature of long expansions where they do go down, where labor gets a bigger share toward later in a recession. Later in an expansion. So, yeah, and we calculate those, and you have to take the precision with a degree of salt. But I would say that what they will show is that, if wages are running at 5%, 3% is closer to where they need to be. Wage increases closer to 3%, roughly, is what it would take to be consistent with inflation over a longer period of time. By the way, I do not think that wages are the principal driver of inflation. You're asking me a very specific question. I think there are many things. I think wages and prices tend to move together, and it's very hard to say what's causing what. But I've never said that that wages are really the principal driver, because I don't think that's really right.
Great. Chris Rugaber at Associated Press. Well, you mentioned profit margins. Those have expanded, did expand sharply during this inflationary period. And while there are some signs that they are starting to decline, many economists note they haven't fallen as much as might be expected, given that we're seeing at least some pullback among consumer spending. So, speaking of causes of inflation, do you see expanded profit margins as a driver of higher prices? And if so, would you expect them to narrow soon and contribute to reduced inflation in the coming months?
So higher profits and higher margins are what happens when you have an imbalance between supply and demand. Too much demand, not enough supply. And we've been in a situation in many parts of the economy where supply has been fixed or not flexible enough. And so, the way the market clears is through higher prices. So I think as goods pipelines have gotten, back to normal, so that we don't have the long waits and the shortages and that kind of thing, I think you will see inflation come down, and you'll see corporate margins coming down as a result of a return of full competition, where there's enough supply to meet demand, and then you're really back to full competition. That would be the dynamic I would expect.
Michael McKee from Bloomberg Radio and Television. Can you tell us something about what your policy reaction function is, your policy framework is going forward? When you look at the economy at the next meeting, are you looking at incoming data, which is by definition backward looking? Are you going to be forecasting what you think is going to happen? Are you ruling out the rate cuts that the market has priced in?
I didn't catch the last part. Ruling.
Markets have priced in rate cuts by the end of the year. Do you rule that out?
Okay, I got it. So what are we looking at? I mean, we look at a combination of data and forecasts. Of course, the whole idea is to create a good forecast based on what you see in the data. So we're always looking at both, and it will, of course, it'll be the obvious.
Dollar coming up a little bit right now.
Inflation. It'll be readings on
nothing
wages,
spectacular
on
anyway.
Economic growth, on the labor market, and all of those many things. I think a particular focus for us going now over the past 6-7 weeks now. And going forward is going to be what's happening with credit tightening. Are small and medium-sized banks tightening credit standards, and is that having an effect on loans, on lending? And so we can begin to assess how that fits in with monetary policy. That'll be an important thing. We'll be looking at everything. It's, again, I would just point out, we've raised rates by 5 percentage points. We are shrinking the balance sheet. And now we have credit conditions tightening, not just in the normal way, but perhaps a little bit more due to what's happened. And we have to factor all of that in and make our assessment of, of whether our policy stance is sufficiently restrictive. And we have to do that in a world where policy works with long and variable lags. So this is challenging, but we will make our best assessment, and that's what we're thinking.
What about the idea of rate cuts?
Yeah, so we on the committee have a view that inflation is going to come down, not so quickly, but it'll take some time. And in that world, if that forecast is broadly right, it would not be appropriate to cut rates, and we won't cut rates. If you have a different forecast, and markets have been from time to time pricing in quite rapid reductions in inflation, we'd factor that in, but that's not our forecast. And of course, the history of the last 2 years has been very much that inflation moves down. Particularly now, if you look at non-housing services, it really hasn't moved much, and it's quite stable. And so we think we'll have to. Demand will have to weaken a little bit, and labor market conditions may have to soften a bit more to begin to see progress there. And again, in that world, it wouldn't be appropriate for us to cut rates.
Courtney? Courtney Brown from Axios. I'm curious how you view the role
NASDAQ
of
did
the
exactly what we wanted to do.
reverse repo facility in the context of the current banking stress. Do you think it's contributing to the stress by making it more attractive for money market funds to compete with banks for deposits? And did the committee discuss any changes to the structure of the facility, or do you see that being put on the table in the future? Thanks.
Sure. So we looked at that very carefully, as you would imagine, and it's really not contributing, we don't think now. It hasn't actually been growing. It moved up, it moved down, and then moved back up to where it was. What happened in the when there were the big deposit flows, which by the way have really stabilized now, what happened was institutional investors took their uninsured deposits and put them in government money market funds, which bought paper from the Federal Home Loan Banks and things like that. Over the course of maybe the last year, retail investors had been gradually, as they do in every tightening cycle, they've been gradually moving their deposits into higher yielding places such as CDs and other things, including money market funds. So that's a gradual process that is quite natural and happens during a tightening cycle. What was unusual really was the institutional investors moving their uninsured deposits and spreading them around and things like that. But it doesn't seem to have had any effect overall on over the overnight repo facility. That is really there to help us keep rates where they're supposed to be, and it's serving that purpose very well.
Sarah Ewald-Weiss, CBS News. I want to go back to the debt ceiling for a moment.
There we
and
go.
talk
Boom.
about that in
Debt
terms
ceiling.
of
Let's go.
Policy. But can you just speak towards what the impact of a default would mean for Americans across the country, the markets, and borrowing?
There we go. Debt ceiling.
Yeah, I would just say it's. I don't really think we should be. We shouldn't even be talking about a world in which the U.S. doesn't pay its bills. It just shouldn't be a thing. And
same
again,
answer.
I would just say we don't. No one should assume that the Fed can really protect the economy and the financial system and our reputation globally from the damage that such an event might inflict.
Look at the stock market. Look at the NASDAQ right here. Coming down. Taking out the liquidity below.
Thanks, Mr. Chairman. Scott Horsley from NPR.
Came back up.
Last week, Vice Chair Barr
Point of control.
a couple of the factors
Rejection.
that he thought contributed to the regulatory.
Coming down towards these lows right here.
Silicon Valley Bank. A policy change in 2019 to exempt all but the biggest banks from strict scrutiny, and also what he called a sort of cultural shift towards less aggressive oversight. You were here in 2019. Do you share that view, and what would it take to get the stronger oversight that you and he said in your release would be necessary?
So I didn't take part in creating the report or doing the work, but I have read it, of course, and I find it persuasive. I mean, I would say it this way. A large bank, not a very large bank, a large bank failed quite suddenly and unexpectedly in a way that threatened to spread contagion into the financial system. I think the only thing that I'm really focused on is to understand what went wrong, what happened, and identify what we need to do to address that. Some of that may just have been technology evolving, we have to keep up with all that, but some of it may be our policies and supervisory and regulatory, whatever. Well, what our job is now is identify those things and implement them. And that's kind of the only thing I care about and I feel like I am accountable for doing everything I can to make sure that happens.
Thank you. Evan Reiser with MNI Market News. Chair Powell, are we in the early stage or nearing the end stage of the banking turmoil among regional banks? And secondly, do you still have a bias to tighten rates? Is that what the statement is saying?
So, I guess I would say it this way.
There we go.
There were
Better questions now.
Large banks, really, from the very beginning, that were at the heart of the stress that we saw in early March, the severe period of stress. Those have now all been resolved, and all the depositors have been protected. I think that the resolution and sale of First Republic kind of draws a line under that period is an important step toward drawing a line under that period of severe stress. Okay. I also think we are very focused on what's happening with credit availability, particularly with what you saw in the beige book, and you will see in the SLUICE is small and medium-sized banks who are feeling that they need to tighten credit standards, build liquidity. What's going to be the macroeconomic effect of that? More broadly, we will continue to very carefully monitor what's going on in the banking system, and we'll factor that assessment into our decisions in an important way going forward.
Okay, Greg.
Thank you, Fed Chairman. Greg Robb from Market Watch. I just wondered if you've done any reflection on your own actions during this crisis and leading up to it over the since you've been Fed Chairman. I think I've heard you say a couple of times that you deferred to the Vice Chair for supervision. Do you think that was the right way to go about this? And comments on that. Thank you.
Sure. So let me say, first of all, I've been chair of the board for 5+ years now, and I fully recognize that we made mistakes. I think we've learned some new things as well, and we need to do better. And as I mentioned, I thought the report was unflinching and appropriately so. I welcome it, and I agree with and will support those recommendations. And I do feel that I'm personally accountable to do what I can to foster measures that will address the problems.
So far, dollar ranging, nothing spectacular here. Euro, nothing spectacular.
The place to start is the statutory role, which is quite unusual. The vice chair, it says...
The only thing that's super interesting right now is the stock market. Okay. This is why we had our main focus on the NASDAQ. We're talking about that right here. Taking out the liquidity that was not taken out completely. Now we're taking out that liquidity. We came back into that range. Point of control is the area where the most volume has been traded. In that range, that was a perfect zone where we put our initial order to. A black bull market did not accept my limit order. I could not put my limit order through. Fortunately, though, I trade also on BlueBerryMarkets on a MetaTrader platform as well. So I have a smaller position there. But again, the NASDAQ was indeed the most promising today. So far, gold also did not make a big move, at least not yet.
Including working with Vice Chair Barr and his predecessor. And I think that's the way it's supposed to work, and that's appropriate. I believe that's what the law requires. And, but it isn't, I wouldn't say it's a matter of complete deference. It's more, I have a role in presenting my views and discussing, having an intelligent discussion about what's going on and why, and that's my input. But ultimately, that person does get to set the agenda and gets to take things to the Board of Governors, and really in supervision has sole authority over supervision.
I just wondered if you had any regrets, or was there anything that, decisions that maybe you regret now in light of what's happened?
I've had a few. Sure. I mean, who doesn't look back and think that you could have done things differently? But honestly, you don't get to do that. Again, my focus is on control the controllable. As one of my great mentors used to always say, control the controllable. What we control now is make a fair assessment,
coming closer,
lessons,
closer to the end,
figure out what the fixes are, and implement them. And I think that Vice Chair Barr's report is an excellent first step in that, but we've got to follow through.
Hi there, Megan Casella with Barron's. Did the possibility of pausing at this meeting come up at all, and how seriously was that considered? I'm curious if you can give us any color as to whether there were any initial concerns about raising rates again, or what those discussions entailed.
So support for the 25 basis point rate increase was very strong across the board. I would say there are a number of people, and you'll see this in the minutes. I don't want to try to do the head count in real time, but people did talk about pausing, but not so much at this meeting. There's a sense that we're much closer to the end of this than to the beginning. That, as I mentioned, if you add up all the tightening that's going on through various channels, we feel like we're getting close or maybe even there. But that, again, that's going to be an ongoing assessment, and we're going to be looking at those factors that we listed in to determine whether there's more to do.
I'm curious too how to interpret that and the changes to the statement. Is the bar higher now to raise rates at the next meeting, or would a strong jobs report or inflation print be enough to push the Fed to tighten again?
I don't want to. I couldn't really say. I just think I think we've moved a long way fairly quickly, and I think we can afford to look at the data and make a careful assessment.
And we'll go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. You mentioned a few times about the lessons you learned from the banking crisis, that you would learn the right lessons. What are those lessons?
Well, I just would start with something that's changed, really, which is the run on Silicon Valley Bank was out of keeping with the speed of runs through history. And that now needs to be reflected in some way in regulation and in supervision. We know now that we know it's possible. I think no one thought that was possible. No one had. I'm not aware of anybody thinking that this could happen quite so quickly. So I think that that will play through. It will be up to Vice Chair Barr to really take the lead.
And making moves here towards the end.
Ways to address that, but I think
dollar coming down a little bit.
I guess I would just say that. Then we're going to revisit. It's pretty clear we need, to me anyway, it's clear that we need to strengthen both supervision and regulations for banks of this size, and I'm thinking that we're on track to do that as well.
Can you be any more specific on stress testing or looking at banks that have specific concentrations in certain parts of the economy?
Yeah, that's what Vice Chair Barr's role really is, and he'll take the lead on that.
Okay, thank you.
Thank you.
Okay, there we go. All right, guys, that's it. All right, nothing spectacular. And look at this. This is kind of interesting to see right now. Let me put on some music real quick. Let's get back into our vibe a little bit here. There we go. Okay, ladies and gentlemen, look at this. Look at this particular candle. This is exactly the candle where we started with the FOMC meeting right here. Okay. At exact 2:30 p.m. EST right here. This is where we ended. This is where we ended, all right? We ended exactly around that particular candle structure as well. Almost coming back to where we started out here. So literally an extremely boring outcome here for the dollar itself. For the NASDAQ, did exactly what I wanted it to do. Exactly. We wanted to place an actual limit order here on the point of control. You guys know that we were talking about this already. That we had that liquidity below. We wanted to come up, get rejected, come down, take out that liquidity. The NASDAQ has been doing that perfectly, coming back to this area. Again, when you see a super clean, and we can clean it up for you guys right now. But when you see a super clean area of consolidation, the first thing that you should always think about is, okay, the consolidation, the expansion, the retracement, the continuation. Okay? Look at the point of control. The point of control is the area where the most volume has been traded. The way you do it is you look at the fixed range volume profile, you use it from the left to the right of that range, you mark out that area of consolidation first, you draw it, and you get a red line. Alright, that red line gives you the indication where the most volume has been traded. This is where the most resistance will be in that range. Okay, usually it tends to come up to tap into that zone, fill up that imbalance, come back into that area, and then this is where you get rejected from. So when you have these things right now, not just news releases or anything like that, but just in general, when you have a clean area of consolidation and you have seen a massive expansion and there is a gap and you want this getting filled here, the best thing to look at it is, okay, which candle structure right now is aligning the best with the point of control? Well, then we come back towards this zone right here, which is this area of supply right there, okay? You see that area of supply? Could also be on a 15-minute. What I tend to do is, okay, I tend to then look at that zone, place my entry right around it, a little bit below it, actually slightly, and then place my stop loss a little bit above it, and to then target, of course, the low, which is then right underneath that zone here. So it can work extremely, extremely well. And at the beginning of the stream, I said, I'm was not very satisfied about the fact that BlueBerryMarkets didn't let me enter any positions. It just didn't let me. That's why I probably will see what we're gonna do with it. But that's why I didn't promote BlueBerryMarkets from the beginning yet. Of course, I need more data, right? More data to test exactly what is going on here. But at the beginning, we tapped into the value area low, and I said the point of control is where we were looking at it, all right? So first of all, I thought, okay, we're gonna get rejected the value area low, and we're gonna actually come down from there. After that, we did decide to make one more move up here. In regards to what he just stated already, there are a couple of interesting things that I would like to go over with real quick that are actually super important, okay? One of these things that I think was super important to take in consideration is the debt ceiling. He was constantly talking about the debt ceiling, and what he stated was that pretty much he said, while addressing the debt ceiling, these are just fiscal policy matters. From our side, it's important that the debt ceiling will be raised in time and the bills will be paid in time. Okay, that means that he prefers, of course, that the debt ceiling goes up. If that's the case, you can print more money. If that happens, then more money will be put into the economy or injected into the economy again, which will then, if you think about it, cause or it shows a little bit more contrast in his overall speech, right? Because he wants to get inflation down, but at the same time, he wants to, of course, increase the debt ceiling, which causes inflation, all right? So keep in mind that everything that he states is kind of weird if you really truly think about what he's actually telling you. However, think about the fact that if that actually tends to happen, which we're going to see in June, somewhere mid-June, we'll get the answer of, are they going to actually increase the debt ceiling? Where does this money will go? Will it go back into the stock market? Will maybe cryptocurrencies start booming like we saw with COVID in 2020 when they start implementing or, printing a ridiculous amount of money again? Okay, so do take that as consideration as potentially bullish for, the long-term stock market. But until that moment, nothing spectacular yet here. I think it's definitely important to be patient. In regards to the other utterly most important question he also had was, are we going to actually increase, or are we going to continue to increase the rates? And he stated that he's going to look at the data and he's not completely sure yet if we are still continue with the increasement of the interest rates in the future. But he's not denying he won't either, right? And 5.25% is extremely high already, especially in this short period of time. We have been way higher beforehand, but it took a long time to get to that point here. We have been, I think it's a breaking record that we have been, increasing these interest rates over a very, very short period of time, which is of course detrimental for, banks especially. And that's why we're seeing all these, smaller banks collapsing right now. I don't know what the reason is and why they let this happen, but like he stated, he doesn't really find it a big problem when big banks are, only getting bigger here, okay? Especially if big banks are taking over the smaller banks, and etc. So it's overall a very, very interesting, outcome. But in regards to today's session, if looking at the actual outcome of the FOMC meeting, I did expect much more volatility, much more volatility than we have seen right now. We are literally at the same moment where we started, pretty much as of right now. Same for the euro, exactly same for gold, nothing spectacular. So what is next? That's the question. Well, that is of course one thing, okay? And that is the most important, I think the most important event or news event that we can expect in general. And that is of course the non-farm payrolls, okay? The NFP is going to get released on a Friday. Expect major moves during that time here. This is actually personally one of my favorite news releases to trade, especially because these NFP or the non-farm payrolls do really provide us sometimes with these massive swings, okay? Where true setups suddenly turn around here. A lot of my swing trading positions came actually from the non-farm payrolls, okay? Talking about the dollar-yen long that we had for a very long time ago, it started at the non-farm payrolls as well. So my suggestion to you is to look more in the next coming, days ahead of you at macro levels. Okay, of course, what we're doing on the streams and stuff, we are only talking about day trading and scalping. But when it comes down to the non-farm payrolls, my suggestion is to look at potential swing trade opportunities for longer term. I think this could be really beneficial. And I think this is where my main focus is going to be also in Discord for the next coming days as well. Tomorrow I'm going to give an event, so I'm going to be there. I think this also will benefit us. We're going to talk about potential swing trade opportunities in the V2 during the live stream as well, because there are a couple of charts that I would like to go over with you guys regardless. In regards to tomorrow news, okay, we also have the ECB monetary policy statement in the evening as well. Then we have the initial jobless claims, quite important. For the rest, I do not expect that much here. During the London, we're going to see the PMI coming out here for the GBP. So I think tomorrow will still be a little bit of a better day to trade. But again, do not expect too much until the NFP comes out. All right. I think this is super important. My question to you guys right now is literally throw me some charts. Let's go over it and look at the NASDAQ coming down perfectly, to that zone, taking out the liquidity. I'm happy when I see, a setup actually playing out in the way I expected it to go here, especially when it's on the dot. So I can be a little bit proud of myself because, sometimes I just like to nail these type of setups here. The NASDAQ, this definitely what we had to do here, while the EURUSD, gold, and all the other ones pretty much stagnated along the way here. So, yes, guys, throw me some charts right now. And let's go over a couple of them. Let's do some analysis. let's see what is going on still. And I think that will be a fantastic closure of today here. Aiken says Australian dollar, Swiss franc. Let's have a look at that. Okay, yeah, we came down already. We know that the Australian dollar was into a recovery beforehand, but then decided to pull back. Again, here we saw that rejection point, so we turned around, we came back to that high, and we eventually got rejected around these particular levels right here. Pretty much a horizontal, strong horizontal level that we have here already for the Australian dollar index. Okay, this represents the strength of the Australian dollar. You see that is reacting as resistance, support, support, resistance, resistance. Now coming back down. I expect a weaker Australian dollar over the next couple of days here. So if we then compare this to then the Swiss franc, we breaking highs right now. So the Swiss franc is looking way stronger. Obviously, combination of the Swiss franc being strong, Australian dollar index being weaker, or at least coming back down right now, testing these particular lows here, gives us one outcome. And that is that the Australian dollar against Swiss franc, of course, will be bearish. So do take that in consideration. When looking at the chart here right now for the Australian dollar against the Swiss franc, is one thing and one thing only. And let's lose our tool right now. Maybe this is a nice tool to look for. And there we go. We have our point of control right here with that particular zone. So I think that we have the zone right here coming back towards that level. And then we have the value area low. We have the point of control right there. And we came right underneath that zone between that area. And we're seeing that this candle structure gave us that rejection right there. Look at that candle structure right there. Tapped into that zone, got rejected. You can get some fantastic risk to reward as well on the higher time frame. So sometimes it is very beneficial. Gives you also a higher probability in general to look out for, these type of setups right here. In the end, we got rejected. We faced some resistance right now. Expect more downside potential. We expect these lows to be tested right there. So my suggestion is right now that I do believe that we're at least going to go for that imbalance already. If you go back to the 1 hour, it will be a little bit more clear what I'm talking about here. We have this particular zone. We have a gap right there. I think this will be filled. So right now, I think that with this liquidity below that zone right here, with that imbalance below that zone right there, I think we can fill up that imbalance and test the lows of the previous expansion we saw beforehand, which is around the 59 cents roughly. A little bit lower, 58.9. Okay, expect more downside potential. So if you go into the lower time frame, simply look for the continuation here and to look for short opportunities right now, coming back into this level. Maybe get a rejection, coming back up, coming back down, and then looking for the continuation. Something in that manner. Make sure it aligns very well with what you're looking for. But these are type of setups I'm personally interested in, especially when the contrast is very big between two different currencies, like indeed the Australian dollar and the Swiss franc. It's actually a fantastic example. The next one. Let's see what we have. Ghost says check GJ. Yeah, let's see how the Japanese yen responded right now. So the FOMC is over, and you see the dollar is now pushing up a little bit here. I'm very curious what will happen, and if we come back here to the Sunday open right now, and how that will affect the other pairs here. But let's go indeed to the Japanese yen first, and let's talk about then the British pound index, and then we're going to go to the British pound against the Japanese yen. Okay, let's do that. So what do we have here? We have the Japanese yen coming up tremendously. We came up, we tested that zone. Again, perfect reaction right there. Okay, we saw that particular move. Really, really nice, clean. Came back down, tapped into the zone and created a new higher high. Internally, we have created new highs. So far it's looking quite strong. The question is, are we able to break this high right now? Because internally, if you look here on the 15-minute, and I think I need to show you this way here, we have broken internal lows right now that are important. So this is gonna be, or is gonna be seen as a strong high here. So if we do not get, you know, the chance to push through this zone, we might see indeed it coming back down, continue its momentum here. And that will be very, very interesting, especially if the dollar will keep rising up right now in the short term. That will give the Japanese yen a chance to push down. We know that if the Japanese yen comes down here and the British pound comes up, that the GJ will be coming up very, very quickly here. So far, you see the GJ is also coming down at the moment. So you probably will see something very, you know, neutral at the moment here. Let's see. We probably came down first, obviously, right here. There we go. We are right now at that zone where we came down to. Well, we could be at a moment where we could maybe pivot a little bit here in the short term. So we are now in that zone. We got back to that range. If you draw the Fibonacci from swing low to swing high, we came back to the 62%. We closed above that level. We wicked a little bit below it, but we closed above it. We tapped into this area of the month. Let's go to the 1 minute. It's actually not looking bad at all here. Now I'm looking at it. Okay. What you want to see, you want to break the 169.861. That's actually the best perfect level to break here. Why? Because then you break that internal high that put in that last low. So then you reverse, come back down, look for the continuation potentially here. If it aligns with, of course, the Japanese yen that we just saw right there. Okay, Japanese yen coming down, British pound stagnating or coming up, to then see GJ breaking this level and then look for a continuation back up here. Could be possible, as we have seen that the yen right now created 50-minute lower low. Now testing that area of supply that put in the low. So keep a close eye on GJ. When zooming out on GJ in general, okay, let's come down and let's look at a little bit of macro here. We are still looking relatively bearish at the moment. So do take that in consideration. However, you see also that we are now bouncing from a 15-minute zone in general here. We talked about internal levels here. But you see that we are now in that particular level here already. And I think that we are now at a crucial zone. Let me see where it is. Coming back towards its last low, of course. And that is the 50% here. Okay, we came back into the 50. So we're not in completely nobody land here. We are coming back down towards discounted zones right now. So very, very interesting where we at. Keep a very close eye on it. My opinion, what I want to see is I want to see the yen creating a lower low on the lower time frame, following by GJ coming back up here and putting in that high first. If it doesn't break this high, there's no need for me to look for short-term setups and scalps at all, in my opinion here. Okay, let's do two more. And I started to see that we have our first giveaway done. Okay, we reached 300 likes here, so let me see what we can do for that. So we're gonna give away at least 50 bucks right now to somebody in the chat here. So that's fantastic. Thank you guys for the support. In the meantime, let's do two more setups right here. Let's see what we have. Lorenzo, did you sleep today? No, didn't sleep yet. Almost 4 a.m. Yeah, EU. Let's go back to EU right now. We're seeing some more movement again. It's kind of ironic right now that we expected the most movement to happen during the FOMC press conference, but that did not occur here. The Nasdaq is coming down here. Consistently coming down right now. That was expected. That is so beautiful. So beautiful. Any other pair, let me know. US dollar, Japanese yen. Let's do that. It's almost 4 a.m. in my place right here. It's 3:40. All right. It's already late for a lot of you guys as well. So shout out to each and every one of you guys still sticking around here. Being in the stream, trying to learn, trying to see if you can get some trades and trying to just become a better trader yourself. I have a lot of respect for that. So thank you so much. Really appreciate it. And it's about the community that we're building here. Only gonna get better and better. So the dollar yen right now indeed, and then we're gonna go to the giveaway, is at a crucial level. Okay, we are, when we're zooming out, back into a very important zone here, where we already have faced a lot of resistance, a lot of support right now. Yes, sometimes we use support and resistance, and of course to just evaluate. And what we're seeing here, and you see clearly that we have been tapping into that zone once, twice, 3 times right there. And now we're back at that level here. So this is number one thing that you can look at on the higher time frame. Okay, on the lower time frame, in my opinion, it's quite irrelevant. We can use supply and demand for that. What do we see now? We came back down towards that zone. We're now holding above it. Yes, we took out some liquidity below it. We're now still ranging above that level here. The dollar is also stagnating. The yen is now getting rejected. So the fact that the yen potentially can get rejected right now, we benefit us maybe here when looking at the dollar yen, but I need to see maybe the yen is coming up again. Let me confirm real quick to make sure that I'm talking the truth. Oh no, the yen is coming back up again. Okay, we were getting rejected, but we're pushing further. So that's quite interesting right now. Okay, we're trying to push out these particular highs. At the same time, we're holding at that major area of support right now for the dollar yen. That's why it's hard to come back down here. But it seems like we are ready to come down there now. If we do close below, and let's say we close a hourly candle below that zone, potential next target will be the 134.294, especially when the dollar or the yen breaks this particular high right there. And the dollar, yeah, whatever the dollar is doing, we still have this whole particular range that we have not even mitigated in yet. Okay, so we have this whole range yet to break through towards. Plus, of course, keep in mind, guys, super important, the Sunday open. The Sunday open is going to face us, or is going to give us a lot of resistance right there as well. I think it's very, very hard to break it. Maybe during the end, we're going to find out when it's actually going to happen. But it seems like the dollar yen is coming down and breaking below. Wait for an hourly closure below it. We might take a short from there, taking it down towards these levels. Okay, or then just go to lower time frame setups. You know, look at supply and demand, look for areas of supply, and trying to get your trade from there. One more. Let's do one more. Looks like gold will continue up here. So, yes, if the dollar comes down, gold will go up potentially here. At the same time, when looking at gold right now, I do see personally, I still see more downside potential. Okay, why? Look at this zone first of all. Okay, let's clean it all up. We are now at a crucial zone. Okay, this area of supply right here is where we got rejected from in the first place. So, do we want to long from here? In my opinion, I'm not really interested in longing gold from there. I'm interested in longing gold from here, you know, lower levels after the liquidity has been taken out. At this particular moment, the only thing that I would look for is shorts, in my opinion. Well, not now as well. Right now, I'm in a no-go zone for gold. But in my opinion, right now, when we are at crucial levels, when we are at crucial areas of resistance right here, I'm not going to look for longs right now. Okay? So that's why, personally, what I'm waiting for is either bearish structures right now for gold to then potentially look for the continuation to the downside and then place my short position. If we do come down first, yes, I will short it. I will then potentially look for longs after that. Why? Long term, bullish on gold, still obviously safe haven. You know what's happening with the market. You know what's happening with the banks and so on and so on. Of course, the major analysts expect newer or higher all-time highs for gold in the very short term by 2023, the end of 2023, early 2024. Already, well, we're definitely at this particular moment going already into that direction right here. So for now, I'm not interested in learning gold, even though gold is coming up. Maybe when we break the highs here, okay, and we break and we set in a new higher high on the 12-hour daily chart here, and we take out these particular highs, maybe looking for something from there. Until that moment, while we're pretty much in crucial resistance right here, I'm gonna be patient and see from there what will happen with gold in the short term. All right, so let's do our giveaway, guys. I leave it up to you guys. What do you want to do? We can do a questionnaire, and the first one that answers the question correctly can win. Or we do something else here. What can we do? We want to give away. We're gonna give away $50. We have 334 likes here. So you guys, we reached our first target. So this could be good. What should we do? What should we do? Let's do Instagram. All right. Many of you guys have Instagram right here. I think that makes the most sense here. We can keep it fair and square as well. Okay. What do you need to do? Go to my last video. All right, I posted a new video right here. Let me see if I can play it for you guys right now. This should be good. Last move here. So we came back up, we took out some of the liquidity, and then we reversed down. So I think the most of the liquidity was built there, was taken out. You were tapping into that OB, which is great. Now you're tapping into the zone. Now you're going to break the lows here. Usually what tends to happen is you break it and you just come down straight away. Why? A lot of imbalance. This action was made to take out the liquidity in an aggressive manner. There we go. Around 5 seconds till we close position. Sorry, candle. We close underneath. Now it gets interesting. Okay, now we're going to get some bottom. I think we're going to see some reaction right here. We're coming down straight away. Wow. A reaction to the downside. Now it's like securing yourself as soon as possible. That's what you do. You wait for a secure, you wait to secure position as soon as possible. If you come up, it is what it is. It is what it is. Usually, we take some profit like we did right now. That's it. I actually saw that last move here. So we came back up. Fantastic. So guys, if you want to join the giveaway, place a comment and a like under this video. Links in the description for my Instagram. We can do it right now in 5 minutes. I'm going to pick a winner. Send me then a message on Instagram. I want to make sure that it's somebody right now that is in the community right here or watching the stream, so we can get this sorted. And then I can actually go to bed. What do you guys think about that? Gonna be amazing. So let's do it. Let's do it. Let's do the giveaway real quick here. In the meantime, the dollar is still coming down at the moment right now. We're still ranging overall here. We had this beginning of the session. We had the end of the session. And right now we're still ranging overall here. Gold as well. Gold is making a little bit move to the upside right now. Probably retesting. Coming up a little bit, filling that wick that we're seeing here. The yen is breaking that high, which is super, super important to take into consideration. Why? That invalidates what I just said about GJ, because we had to hold underneath this initial zone right there. Okay. What do we see now with the stock market or in general? The volatility index is massively expanding here. I was already looking very, very bullish. We were talking about this as well here. So that's why we were looking for any particular NASDAQ short today in regards to the FOMC. I do expect right now that we are at the end and that this could be the moment for us to pull back a little bit again, which will cause the NASDAQ to come down or come up again now as well. with the combination or with the fact that the dollar right now as well is coming down a little bit. However, I'm not that particularly bullish yet whatsoever right now at the moment either when looking at the overall market right here. But man, that was my exact position right there. That was it. A little bit below, stop loss above. So see how that played out here. This is on another chart, on the Owanda chart. Look at that. That's exactly what I was personally looking at right there. Okay, this is what I mean. So this is where my analysis was. My initial entry, then my stop loss was above that zone. So it was a little bit lower. But because I didn't want to miss out on that trade setup right there that I didn't get triggered. But what it did was it actually tapped into it literally on the dot right here. Okay. So yeah, stop loss was above that zone and then coming back down, taking out all that liquidity below that level. So yeah, like we discussed this in the previous stream, that played out perfectly. So that's great to see there. Are you guys placing some comments right now? Let's see what we have. Sorry for that. There we go. I think we are doing it. So we can start very, very soon. Make sure it's only one comment, okay? Make sure you play it fair and square. Otherwise, other guys in the community will see it and they will text me and then I cannot give you the giveaway. Okay? We make sure that everyone has equal chance to win here. There we go. Let me know once you guys are ready. Then we can do it right now. Let me pick out the link here. There we go. We're gonna pick a winner right now. Instagram comment picker. We're probably gonna see a oh, there we go. It didn't happen here. Usually I need to pick the cars or the whatever, the bicycles. You guys know what I mean. There we go. Enter the post URL. We scan it. I'm gonna make sure that it's somebody actually in the community right there in the chat so that you guys are actually watching it. Otherwise, we do it again. Okay, just to clarify that. Winners are determining. There we go. Are you guys ready? Let me know in the chat. Press a 1. And the winner is... The winner. xauusd. My man, xauusd. Let me know if you're in the chat. Then I know you won. Congratulations, you won. Send me a message on Instagram. I sent you the money right there. Make sure that though you have a crypto wallet. Oh yes, you're there, man. Fantastic. Okay. Congratulations. Guys, thank you so much for the stream. I hope you guys enjoyed it. Tomorrow I'm going to be back with a regular session here in New York. We're going to trade. As usual, hopefully the market is a little bit better, okay? So we can actually take some good solid trades here. This week has not been perfect. Of course, we know why. But yeah, regardless, I'm going to be there. Anyways, ups and downs, we're going to do it together. And we're going to make some money together over the long term. This is what we're doing here. We're going to get wiser, better, and more connected every single week. All right? Thank you guys so much. Enjoy. I'm going to go to bed. 4 a.m. Time for me to sleep. Love all you guys, all right? Take care. I'll be back tomorrow. Ciao. Bye-bye.